Hello and welcome to a fresh new edition of Taking Stock. We tell you how the week has been, but we also prepare you for what the week is going to hold, the upcoming week that is. I am Prashant Nair, as always, with my colleague, Surabhi Upadhyay. Hi, Surabhi.
Hi, Prashant. Interesting week, I guess. One in which the bulls managed to retain at least some upside.
Absolutely.
And the buying in mid-caps continued.
Absolutely.
So as we start off, let's quickly recap some of the cues and some of the trends that we spotted in the course of the last 4 days, truncated week, of course. Now, first things first, it's a market that seems to be feeling good, at least as far as levels are concerned. The index has managed to put on about 1.5% for the week gone by. But really, the theme of the week is the continued resurgence in mid-cap and small-cap stocks. If you look at those indices, and the mid-cap index is up 2.5%, the small-cap index put on well over 4%. So the broad-based rally that began somewhere about 10 days ago, that is continuing. In fact, in the week intraday, we managed to touch a level of 11,089 thereabouts. So very close to the top of the current range, the recent range. Let me quickly talk about some of the trends, some of the movers and shakers of this week. In terms of stock action, large caps, you had auto stocks in general move back in favor. And Eicher would be a case in point. We've got double-digit gains on some of these, including Eicher, HPCL, NTPC, ITC with the price hike on a couple of cigarette brands. That was a stock that was in focus and it ended positive for the week. On the losing side, IT, technology has taken a back seat as interest shifts to the other side of the market. So HCL Tech, Infosys, Wipro. Of course, on Wipro, added news because promoters sold some stake in the market. So that was a stock that was under pressure throughout. But this has been the weak pocket and some profit taking on a stock like Z Entertainment as well. Mid-caps really was the flavor. That was a talking point and that was a theme. So quickly, just to run through some of the big mid-cap gainers of the week. Repco Home, Avanti Feeds, Gujarat Gas, Interglobe Aviation, financial names like Allahabad Bank, L&T Finance, Ujjivan, South Indian Bank, and Escorts. It's really cutting across sectoral lines. A widespread mid-cap rally is what we've seen in the last 4 days gone by. Now, just a word on some of the triggers and some of the talking points that we heard during this week. One, of course, the global growth scare is back. It played out in international markets on Friday, didn't impact us that much, but it was definitely a talking point. And second, the talk about flows. On the FII front, we continue to be positive. In fact, for the month of February, we are up almost 4,500 crores. So that's the good bit. The concerning bit seems to be what is happening with domestic liquidity, because we got the mutual fund numbers for February. And I guess, Prashant, that's a bit of a worry point at 5,000 crores.
I mean, it keeps coming lower, doesn't it, Surabhi? So absolutely. So I think just want to start with that. Then we'll just look at some of the global factors at play as well. So 5,100 odd crores is what we got in the month of December. I'm talking about equity schemes. The only silver lining is that the SIP number is still pretty steady. I mean, it is close to about 8,100 crores. It's been flat now for the last 3 months. December, Jan, Feb, it's been around that 8,100 crore mark. But, you know, the fact is that interest is coming off a little bit, maybe. It could be market conditions, it could be trailing performance, near-term trailing performance, it could be commission structures, whatever you want to ascribe the problem to. But the fact is that flows aren't what they used to be, and that is a problem in case FII start to sell once again. They've turned buyers recently. Okay, let's get to the big theme as we head into next week. To me, the big theme, globally speaking, is the fact that central banks around the globe have once again turned dovish. The latest to join the pack is the ECB and what they announced on Thursday. Now you have the ECB, which, I mean, there's no telling at what point will they increase rates, or even if actually they will at any point at all. You look at the Fed, which turned dovish towards the close of 2018. You look at the data coming out of China. I mean, on Friday, we got the export numbers, right? Big disappointment, big miss in exports. And China has already been stimulating both monetary and fiscal-wise. So you've got three big regions, three drivers in that sense, stimulating and not really normalizing monetary policy or fiscal policy. So for now, and, you know, this is especially after the ECB, and of course, you saw what happened in China on Friday, which is that we ended about 4% lower. The fact is that the market seems to be paying attention to the reasons why central banks have turned dovish, which is that the underlying global growth is weaker, or is projected to be weaker than expected. And so risk assets are reacting to that. But the question is, will they at some point start to once again get into the mode where they actually rewarded risk assets in the belief that liquidity is ample, you got to chase yields, and central banks are in no hurry to normalize. Will we get to that point at some point? I think we'll have to wait and find out. Just two other points, and this I come back to the S&P 500, the big global mother market. I pointed out that S&P 500 has seen a triple negative divergence, and I said this last Friday. It's if it closes below the 2,775 level, that's the hard number, it would qualify as a bearish outside week on the S&P 500. It only confirms that in the near term there could be a meaningful correction. Just a correction, no trend reversal or anything of that sort, but a correction which might be on the anvil. If that is the case, will we start to see some impact around global markets like India, etc.? We'll have to see. But that's what the US market is telling us, that maybe it's in the throes of a correction which can continue for a bit. And of course, I mean, I said this last week that we will probably get the election dates, and we most likely will get it now, and that basically will sound the campaigning and the focus on politics in more ways than one. So that's essentially the week which is coming up in front of us. Surabhi.
Okay, well, so those are the cues that we need to watch out for. Joining in to discuss a lot of these trends this week with us is Nilesh Shah, Managing Director at Kotak Mahindra Asset Management Company. Nilesh, good evening. Always a pleasure having you on the show. Thanks for joining in. Now, first things first, this number that your fraternity has thrown up, 5,000 crores in the month of February, it's been a steady decline. And my question is this. Are we looking at domestic liquidity becoming a concern or a threat for this market? Or would you just call this a passing phase?
My self-interest pushes me to say that this is a passing phase. So to that extent, discount me. The reality is that, yes, there is about 5,200 crore flows into equity fund, but there is a redemption of almost 1,000 crore in balanced fund. Many of the balanced funds in the past were sold on a dividend yield basis. In a falling market, dividend yields have been maintained from the past surplus, but your NAVs have come down. There is a mismatch between investors' expectations and the experience, and hence there is a redemption coming through. On the other hand, a couple of positive things which gives us hope for the future. The SIP numbers have remained steady at about 8,100 crore. The ETF flows have moved up. It's now about 5,000 crore, almost equivalent to broad equity flow. So this combination, when you take broad equity plus ETF put together, that's almost 9,200 crore. And that's a reasonably decent number. It's still positive, massively positive. Hence, domestic market should not worry about selling from the mutual funds.
Nilesh, the CPS, I mean the ETF number, the equity ETF number, that is not really coming to the market, is it? I mean, that is basically, it's the government which is mopping up. And that number expands to 4,000-5,000 crores even more when, there's a CPSE ETF is mopping up funds, and then it goes to nothing. And it goes deep in the it goes the other way as well. So should we really count that as a steady inflow number?
No, Prashant, you are absolutely right. CPSE ETF, if we have seen the experience, it starts with a bang and then comes down dramatically. But there will be some flows from Provident Fund organization. EPFO has been a large buyer of index funds. There will be many Provident funds which also might be putting money into it. So if we take out that buying from the Provident funds, that could be, long-term and sustainable.
Just, Nilesh, one more point on this mutual fund thing, the flows thing, and then we'll move on. What do you think happens when there is a market bounce? I mean, typically we say, well, if markets start to do well, flows will come back. But, if performance picks up and gradually continues to pick up, will we see one big bout of redemptions? I mean, if you bought something at 100, it falls to 90, and then it comes back to 100, many people would want to say, okay, I'm getting my capital back, let me get out once, right? Is that something which we may see if markets continue to bounce, and then whatever happens?
So today, mutual funds cover about 2 crore investors, and it's a very, very heterogeneous group. So in one part of mutual fund investors, what you have said will definitely happen. There will be kind of loss booking or profit booking, whichever way you call it, but once your investment comes to the cost value, there are some set of investors which might redeem. On the other hand, there is equally large part of investors who continue to invest via SIP. There is also another set of investors who is happy to invest when a momentum builds up rather than catching a falling knife. So in this very, very heterogeneous group, it is difficult to say when there is a bounce back in our NAVs, and some of the PMS schemes which we manage have seen significant upside over last 10-15 days. It's difficult to estimate whether people will put money because they have seen momentum building up, or will they redeem money because their value or cost is recovering. It's too heterogeneous group to make a comment.
Okay, let's see what the coming few weeks and months give us in terms of the flows numbers, Nilesh. I just want to move on now to the market as a whole and this resurgence that we've seen. You know, some put it on border issues, some say now the current government dispensation will come back with a clean majority, and that's inspired the rally. What do you think it is? What's the trigger that's led to this, interest coming back in mid-caps? And do you think it's sustainable?
So the biggest trigger was valuation. Mid-caps and small-caps were trading at discount to their 10-year historical average. And that valuation kind of triggered investor interest. But this valuation was lying there not just for last 10 days, it was lying there for probably last 10 weeks. So the catalyst for this turnaround is obviously the flow. Surprisingly, just one day before budget, from 31st of Jan, we have seen reasonable amount of buying from long-only FIIs. This is coming under the context where our weightage in MSCI index has come down. There will be impact on passive funds. And despite our weightage coming down in MSCI Emerging Market Index, the long-only FIIs have been regular buyer from 31st Jan onwards. Between 31st Jan till today, my guess is that they would have pumped in close to $2.2 billion. The second thing what has happened is that some of the domestic money, and I'm not talking about domestic institutional money, but non-institutional money, has also started moving into the market. They have started accumulating small and mid-cap stocks, and this is reflected into the price movement and delivery volume. The third has been a slightly subdued support, but yet positive flows from the domestic institutional investors. And combination of lower valuation and better flows has resulted into sellers stepping out a little bit and buyers moving in aggressively a little bit. Combination of this is resulting into prices recovering by between 10 to 20% from bottom.
Nilesh, as we head into elections, will the bottoms really hold? Will the levels that stocks in the broader market has come off, is there a chance we retest those levels, or they're done and this pre-election rally will continue? What is your best guess?
My guess is that market at every point of time is discounting event to figure out what will be the shape of the government. Certainly at this level it is pricing in an economic reform oriented government, a stable government, and any event which changes that expectation or which influences that expectation will result into market movement. So if the events continue to support this behavior or this expectation that there will be stable government and they will pursue economic growth policies, then markets will remain elevated or firm. But if there are events which shakes that expectation, which leads to a different conclusion of a coalition government, then markets could have correction. So from here till May 2019, market will continuously try to discount what is the shape of the coming government.
Nilesh, on that point, is the hypothesis that the market is building in correct? I mean, there is no science to this, right? I mean, it's just a feeling that maybe the hand of the current government has been strengthened because of the events of the past 2-3 weeks, right? I mean, it's just a sense. But how do you think about it? Yes.
So one, market has collectively gone wrong in predicting elections in 2 out of last 3 times. In 2004 market, or we were wrong in predicting elections. In 2009 also we were wrong in predicting election. So effectively, market has to realize that we don't have superior power to predict elections. And we have seen even opinion polls and various ways to predict elections has not become accurate or correct. So market knows fully well that it's difficult to predict election in a heterogeneous country like India. Yet as a market it has no option but to continue to discount what could be the possibility, and hence we will see the similar behavior.
Okay, Nilesh, we will have to leave it there for this evening. Thank you very much. Interesting thoughts. Let's see. We are heading into a busy season. One will have to wait and see how some of these events unfold. Thank you.